Welcome to the Art of Money Podcast with Art McPherson.
And this is the Art of Money Podcast with Art McPherson and Luke McCarty, artofmoneyradio.com for more information on the McPherson Financial Group or to schedule that initial complimentary consultation. We appreciate you listening. Now, let's get to the show. The Fed, they're may pause interest rate hikes to give them a chance to work against inflation. Now, if that doesn't work, there are concerns that we might be in store for some more stagflation. Art McPherson, Luke McCarty, number one, define stagflation for us, and more importantly, how do we protect ourselves from it?
Sure. So stagflation is when you have a slowing economic growth. We have that. High inflation, we have that. What we don't have currently is a high unemployment. So to have the full stagflation, you need slow growth, high inflation, high unemployment, similar to the 70s. You know, the 70s had 3 different waves of inflation. If we're similar to that, maybe we're coming down off the first wave, but, you know, the Fed and the government continue to find ways to backstop the banks and print more money and, you know, call their treasuries and things at par and spend a lot more money. So we'll see. So we are 2/3 of the way there to stagflation, according to my math.
Yeah, and hopefully we don't go down that road, because we saw Japan go from that road, down that road for about a 20-year period. So when you make money too cheap and you do too much printing, it has a long-term effect, and Japan went through that for a 20-year period of time. So I hope our wiser heads apply in this matter with our Fed, and they get the politicians, whether they're what side of the aisle, it doesn't matter, but they need to start being cost sensitive. So they need to start cutting cost, because there's no such thing as a blank check, and everything does have a cost, whether it's a cost today or a cost in the future. But we've gotten to a point now where anything we do, it's going to show up pretty quickly with inflation.
So what can we do, Luke, to protect ourselves from this stagflation?
Yeah, so you have to have your assets diversified. You know, if we go back to my, comment about the 70s, right? I believe from like 1968 to 1982-ish, the S&P 500 ended flat. You went up, you went down, you bounced around. So that's just owning 500 U.S. companies. So in order to, fight stagflation, you need diversification. So one thing we did recently is we added in international back to our portfolios. They've been out of the portfolios for several years because the U.S. has outperformed for the last 12 or 13 years. But now it may make sense, as potentially the value of the dollar is falling. When the Fed cuts interest rates, the value of the dollar will drop, and that will mean the exchange rate from different countries will be favorable in their currencies. So you want to own some international, you need some diversification. Now's not a bad time to own bonds, right? The credit market, the bond market's predicting a recession, so bonds are up this year 3 or 4%. So you really just need diversification. You can't just put it into the things that have been working recently, because if we go through a time like this, it's going to be something completely different. And let me add one more thing. We added to our position in gold as well. So now we own more gold. So there's certain things that work during these time frames, and you need to own some of them.
And one of the things that we're doing right now, we haven't been able to do this since 06, 07, is we're using banks again. So we're using some CDs, we're using fixed cash money markets that are paying in the 4.5-5% range. So there's a way to make some money without any credit risk or market sensitivity to it. So we take advantage of those when they're there, because getting a 5% guaranteed kind of rate is not a bad thing for sure. Now it's still losing a little bit to inflation, so you can't just do only that. You got to have other investments and other assets that can have that potential for growth. But one of the things that is scary about stagflation, which Luke brought up, if you go through a 20-year period of time and you're just in the Index 500 ETF, well, if it's like in the 70s where it really doesn't grow over a 20-year period, that strategy is not going to work very well. So you want to be in something that's more actively managed than that. You want to be able to have other assets mixed in with your portfolio than just like the S&P 500, because those things, even though they've worked well the last 10 or 15 years, doesn't mean they'll work well in the next 10 to 15.
Luke, you mentioned bonds as a good option right now. We've talked about it here before on The Art of Money, that over the past year and a half, bonds have been getting hammered, but you feel like bonds are making their way back.
Bonds are making their way back with the anticipation of the Fed cutting rates, right? When the Fed pivots, that's when the bond market starts to, rally, but the bond market's rallying ahead of it. So we here at McPherson Financial Group got out of, I'd say, the majority of our bonds in December of 2020. So right after COVID, right when rates went back to zero, Well, where are rates going to go from there? They have to go up. We didn't think they were going to go up this fast, this quickly. Neither did the Fed. The Fed told us incorrect data every month, every week. But here we are. So your risk right now is, is the Fed going to raise another 5%? No, they're not going to. That's a big jump. Well, that's the jump they did last year into this year. So we're thinking from a bond market perspective, there is some value in certain types of bonds. Not all bonds, but certain types.
Yeah, because basically when rates go down, bonds will overperform. So you'll get the yield that the bond's paying, Mark, but then you'll also get, if the rates begin to fall, because your bond, you bought it when it was paying 5% or 5.5% or 4.5%, and now the new rates are only 4.5%, the bond will actually increase in value to match the new yields. So it's actually a good time to own bonds. So we think bonds will be overperforming in the next couple of years, where the last couple of years they've been underperforming and actually losing large sums of value.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.